Wie geht es, meine Freunde? Wie geht es euch alle? Danke, dass ihr vorbeigekommen seid. This is my canal. My name is Mark. You are watching Uncultured Currency. And today we're going to discuss the recent jobs report. When I say recent, I mean from last week. But there's a potential chance that there could be some inaccurate numbers. And this could potentially throw a wrench into the Fed's positive outlook. And everyone's now looking forward to tomorrow's meeting with the great and only money printer, Jerome Powell.
I'm Joe Biden, and I approve Uncultured Currency. Make sure you subscribe. All right, you whippersnappers, can I get my ice cream now?
The jobs report is a critical piece of information for the economists and policymakers as it provides an overview of the state of our labor market. Now, the report from January 2023 showed a significant increase in employment, which initially appeared to be positive news for the economy. However, there's been this growing concern about the accuracy of the report, with many experts claiming that the numbers may be inflated. According to January's U.S. jobs report, it was stunning all around, unexpected. People were shocked. Non-farm payroll increased by 517,000 for the month, shattering analyst estimates of 187,000. Unemployment rate fell to 3.4%, the lowest since May of 1969. That shows you, Trump, Biden is doing it.
You are fake news.
Sir,
go ahead.
With those numbers being so positive, you would think that the market would see things as good news. But here we are, we live in the upside down world where Wall Street slash market makers slash the boogeyman who controls the numbers believe that this could actually affect the Federal Reserve's interest rate trajectory and potentially continue to raise interest rates longer than expected and anticipated. But what is interesting is with all these positive numbers, which is really weird because we have all these positive numbers, but for months we've been hearing about layoffs after layoffs, with Amazon laying off 18,000 workers, Coinbase laid off 2,000, Dell 6.5 recently, Google 12,000, IBM 4K, Microsoft 10K, and the list continues to go on. So it was shocking to see those really positive numbers. This is why the Fed minutes are so important. Now, the FOMC statement is a brief summary of the committee policy decisions. The minutes, which are typically published 3 weeks after the meeting, provides a more in-depth understanding of the decision-making process with more context. While the FOMC statement is a summary of the decision, the Fed minutes can provide a more insight into the varying opinions of the committee members and the reasons behind the policy decision, including any major changes from the FOMC. So here we are again at the crossroads. After the FOMC meeting last week, traders took this as affirmation that the Fed will back off rate increases and could cut rates later this year.
What do you say we cut the chit-chat? A-hole!
And that drove the bond market rally and a sharp drop in interest rates. But if you focus on a different aspects of what Powell's remarks were, it becomes a little bit more clear that this path is by no means assured. And seeing the numbers from last week that were positive, you can expect you could see a shift in sentiment. And we were seeing that right now. Ever since Friday, the S&P 500 started selling off, dropping. And now here we are in anticipation once again for Jerome Powell to make an appearance and speak on this, possibly at the Economic Club at Washington tomorrow on February 7th. So you're probably here wondering, what are my thoughts? Mark, what do you think? Well, to be honest, I don't know what I think. I'm literally reading off a teleprompter right now. So I ask you, why do you care what I think? You're here because I'm handsome, of course, and you like me, and that's the reason why you're going to subscribe. And that's the only thing that I ask for. Right now, eventually I'm going to grift and I'm going to ask for money, but for right now, just subscribe and enjoy my content, and hopefully you do, and hopefully you find me kind of funny. I try to be funny. I try to be, unique with my editing. I don't know, you get my point. So here we are now, it's February, and the market's been selling off for 2 days, and I'm sure if you look on CNBC or Yahoo News, people are freaking out left and right. I'm sure there's a bunch of YouTubers right now saying that the world is going to burn, sell everything. And as an investor, I understand how this could make you nervous because once again, we've had a massive rally. A lot of stocks have been going up close to 40 to 50%. I'm talking about Meta, Netflix, Tesla. And people were getting super excited. But here's the key levels that I was looking at to decide whether or not I want to start going heavy, and if I feel like the sentiment has changed and if we're now in a bull market. In S&P 500, specifically the SPY, I looked at two key levels. 410 and 415. Can the market hold above those two levels? And as of right now, it doesn't seem like it's happening, and it's most likely due to the fact that there's some uncertainty about these numbers, and tomorrow the Fed is going to be talking once again, which is making investors nervous, and you will likely see everything kind of flat out until we decide what direction we want to go into, pending what Jerome Powell says. Is it going to be positive? We're going to shoot to the sky. Is it going to be negative? We're definitely going to drop. But as a trader, do you really want to start trading and holding things long term? I'm talking about a month, 3 months, years, leaps. Do you really want to do that right now? My personal opinion, no. I'm a vertical spread type of guy. I've been doing vertical bear call spreads for a while, and I really enjoyed it, along with cover calls as well as cash secure puts, which has garnered me a pretty good return. It's not life-changing money, but it has worked out for me for the past 6 months. And I can tell you that in this type of environment, you want to look at other ways to try to make money, especially if you're a trader, versus just doing naked puts and naked calls. Look into the other ways that you can make money. Like I said, I've been doing vertical spreads. I've enjoyed it so far. And today, did I trade? I didn't, and I'll tell you why.
Open it! Open it! Open it! Open it! Open it! Open it!
Today I didn't trade, and it's because I just didn't feel comfortable. And this is one thing that traders need to learn. You do not need to trade every single day. If you don't see your ace set up, don't take it. It's simple as that. I know it sounds crazy because you always want to watch the market, especially if you're a newbie. You just want to see it and you want to watch it and you get the FOMO. Next thing you know, you click the trade button and you lose the trade. But today, when you looked at the market, one of the reasons why I didn't end up trading is because pre-market, S&P 500 sold nearly over 0.5% already, where the NASDAQ already sold off 1.5. So when I see a massive sell-off or a massive run-up pre-market, I tend to try to stay away. And that's exactly what happened today, and I'm glad I didn't. But again, it's just me. It's my opinion. Every trader has his own way of trading. I like to be very risk averse, and I don't like to take massive crazy trades anymore. And that's just me. So what'd you do today? I'm serious. Did you end up trading, or did you not end up trading? Did you end up buying more stocks, or did you just sit on your ass and just do nothing? Sometimes that's the best way to move forward, is do nothing. I still, for 2023, my prediction is that we will still either be flat or in a bear market territory. I still don't see some massive run up. Even though the month started off great, I'm not getting too excited until we literally get over 415 on the SPY and actually hold it. Then my thesis will change.
Okay. I just got cultured.